Hello there. Did you notice that last Friday miners broke out of a 2-year downtrend and gold is above $2,200? So it's a good time to have a look at how these miners are doing, especially given that their Q4 2023 results have been published. In this video, we're going to have a look at fundamental valuation of top 3 largest gold miners in the world. That's Newmont, Barrick and Agnico Eagle. Basically, in our fundamental valuation, we have a look at discounted per share value after taking into account all-in sustaining costs, long-term debts and taxes. Within our data-driven approach, we do take into account gold price, reserves underground, all-in sustaining costs, long-term debts, taxes. We look at the value per share, discounted, so we take into account time value of money, and throw a little bit of an insider sauce. But even with this long list of factors to take into account, you see that it's not an exhaustive list. Share prices of these miners might fluctuate from day to day, from week to week for a number of reasons, including management decisions, changes in jurisdiction policies, as well as market sentiment. But while we can't take everything into account, in the longer term, share prices do tend to diverge towards these longer term valuations. So starting with the first factor here, gold price, we're going to have 3 scenarios for our gold price. Balanced scenario is based on only $2,000 per gold, while it is right now already above $2,200. That's closer to our optimistic scenario of the gold price, that's $2,300 per ounce. And in our conservative scenario, we're going to plug in the gold price of $1,700. By the way, talking of the recent breakout in gold price, miners are breaking out as well out of this 2-year downtrend line. And with that in mind, we came up with a new plan a couple of days ago. So for more frequent updates, make sure to join us at myfinanceteacher.org. For that, simply click this Join Now button. Moving on with the fundamental valuation, let's look at reserves and resources, where we look at proven and probable reserves as well as measured and indicated resources, meaning that we don't take into account any inferred resources or further exploration success, hence leaning slightly more towards the conservative scenario. Zooming in on the numbers a little, we clearly see that the Newmont has the largest amount of reserves and resources of gold, followed by Barrick, then followed by Agnico Eagle with a substantial gap. Same is shown on these charts. P&P reserves are in blue and M&I resources are in red. All the numbers are in millions of ounces in the ground. Next, let's have a look at reserves and resources of silver. Again, let's just zoom in on the chart a little. Once again, we see that Newmont and Barrick do have somewhat similar reserves and resources, but Newmont has more of P&P, while Barrick has nearly double the amount of measured and indicated resources compared to Newmont. Agnico Eagle has significantly less silver underground. And lastly, let's have a look at copper. And the situation is again relatively similar. Newmont and Barrick are well ahead of the third largest miner, Agnico Eagle. Newmont has over 30 billion pounds of proven and probable reserves of copper, whereas Barrick has just over 12 billion pounds of proven and probable reserves of copper. For M&I resources, those two giants are relatively close to each other. Next, moving on to all-in sustaining costs, long-term debts and taxes. For taxes, I simply assume a flat tax of 25% to make everything smoother and quicker, otherwise I'd have to spend too much time on these valuations. All-in sustaining costs, unfortunately over the last 2 or 3 years, all-in sustaining costs for most miners have been rising. That's, by the way, one of the reasons why miners are underperforming versus the gold price itself. Now, looking at the guidelines into 2024, Newmont expects all-in sustaining costs at $1,400 per ounce, Barrick at $1,370 per ounce, and Agnico Eagle at only $1,225 per ounce. Looking at long-term debts, compared to last quarter after the Q3 reports of 2023, long-term debts for all 3 of these miners have increased as well, with Newmont at nearly $7.4 billion in debt, Barrick at nearly $5.2 billion in debt, and Agnico Eagle at nearly $1.9 billion in debt. I also show cash position here at $3 billion for Newmont, over $4 billion for Barrick, and nearly 340 million for Agnico Eagle, but cash doesn't actually go into the calculations within the model. I simply show it here as an additional measure of risk. Remember Goldcorp from a few years ago? That used to be the largest gold miner in the world, faced troubles due to lack of liquidity. Next, moving on to shares and discounting. Zooming in a little, we see a number of shares outstanding in millions. That's over 1.1 billion for Newmont, over 1.7 billion for Barrick, and nearly $500 million for Agnico. We do look at the per share value in our model. Insider shares are highest for Barrick at over 0.5% held by insiders. Larger insider shares is a positive sign which would align the incentives of the management with those of the rest of the shareholders. Annual production at the nearly 7 million ounces per year for Newmont, over 4 million ounces per year for Barrick, and nearly 3.5 million ounces for Agnico Eagle is used to calculate this mine life of proven and probable reserves in the ground, which is again highest for Newmont and Barrick at 21 and 19 years, and Agnico's mine life is around 16 years. That affects our discounting as we do take into account time value of money with a discount rate of 5.5%. And yes, I realize that in the current environment of relatively high interest rates, perhaps this discount rate isn't high enough. On the other hand though, the Fed does expect to cut the rates 3 times by the end of this year. Moving on, finally we arrive at our valuations. Again, we do look at the discounted per share value after all-in sustaining costs, long-term debts and taxes. Here we look at a conservative valuation where we plug in the gold price of only $1,700, and in this scenario we look at only proven and probable reserves in the ground without giving any value to any of the resources, including M&I resources, which sort of shows where share prices might drop if gold price just drops out of bed here. We see Newmont at over $20.20, Barrick at nearly $7.50, and Agnico Eagle at over $25.20. These numbers are of course well below current share prices. Moving on to the balanced scenario, we plug in the gold price of $2,000, but even in our balanced scenario, we only look at the value of proven and probable reserves in the ground, without taking into account any M&I, never mind inferred resources. That gives us over $43.3 for Newmont, over $15.4 for Barrick, and over $42.3 for Agnico Eagle. In fact, current share prices aren't that far from the balanced valuation at the moment, although the gold price is much closer to the optimistic scenario rather than the balanced scenario. And that shows you that gold miners have been undervalued for at least a couple of years. Finally, coming to our optimistic valuation, let's plug in the gold price of $2,300, and in this scenario we'll look at proven and probable reserves as well as only half of M&I resources. Again, even in our optimistic scenario, we aren't overly optimistic. We don't take into account half of M&I resources and any of the inferred resources in the ground. With all of that plugged into the model, Newmont is over $87, Barrick is over $39, and Agnico Eagle is over $77. And while gold price isn't that far from $2,300 right now, it's probably gonna take a while before the miners catch up. For that, we'd probably have to see gold price breaking above 2,300, then testing it successfully as support. Then we'll likely see gold miners finally catching up to gold price. By the way, I have an interesting video on gold miners versus gold price over the long term. The link to this video is on your screen right now. Have a wonderful weekend. Bye bye.